discovered the chapter in your book is not adequate for what we need to do today. And it's not adequate in two ways. First, it offers too much of an analysis of one particular thing and doesn't cover at all one important thing that I want to talk about. So we're going to be dealing, it's partially covered in your chapter 8, but you're not expected to read carefully chapter 8. For this particular lecture, just follow the lecture, revisit it online because I'm recording it and I will post it, and I will send you a brief written material summary of the lecture, written summary of the lecture, and that's the only thing that you essentially need to read. You can consult the book chapter, but you don't have to read it very carefully. So that's it. The theory that we are going to talk about today is a theory of competition, or actually two models of competition, two different models of competition. And the reason I said that chapter 8 in your book is not adequate is that your chapter covers only one of these two models that I want to talk about, the so-called price searcher model of competition. However, it doesn't cover the most basic one, the crucial model that all analysis of the theory of competition always begins with. That's a theory of price taking model, so-called price taking model of competition. So we'll see next time. I will say something more about competition than these two simple models that we are gonna define today. What these two models have in common is that they try to study a competitive process of rivalry between the firms on the market in static conditions. So these two are static theories of competition. So what static theory in this context means is that we assume that the conditions and the environment within which the competitive process is taking place are given, unchanged. So technological recipes and ways of producing things are given, by and large given and unchanging. The products that are being sold and produced are defined, they do not change. The innovation is by and large almost eliminated. In the price searcher model, some small level of innovation is allowed. In the price taker model, this basic one that your book ignores completely, innovation doesn't exist. So now you may think to yourself then, what is the purpose of studying competition if you, by the very definition of your model, exclude many of the things that we usually associate with the verb to compete? What kind of competition is that if you're not allowed to change the product, to innovate, and so on? The answer to that question, the full answer, for a full answer to that question, you will have to wait until the end of this lecture, but just the preliminary justification for that is that to remind you that we use models in economics not as realistic description of the world around us, but as useful simplifications. When we want to study one phenomenon, we very often disregard or bracket out or assume away certain complications that would have complicated our analysis. In this particular case, we want to eliminate the effects of innovation and change in order to study how firms, that's an important problem to study, how firms compete against each other in terms of their prices that they're charged and quantity of product that they produce. So these two models are devoted to an analysis of this important aspect of the competitive process. What firms can do with the prices of their products, how they can compete by increasing or decreasing prices. And second thing, how firms can compete by increasing or decreasing the level of production of the products that they sell. So if you want to analyze these two problems, then you have to, for a moment, forget about innovations and changing products. You assume that you are selling the same product in the same time. You have to forget for a moment about all these complications like changing products, limiting your production, or completely changing the production process, and so on and so forth. That doesn't mean that you believe that all competition in the real world is happening without any technological changes and changes in the ways how products are produced or in the product design and so on. You just, for now, in order to study these two important factors, you disregard it. Okay, so that's a justification for both of these simple models. So we will start with the price taker model. Sometimes this model of competition is called perfect competition. The older textbooks would use the term perfect competition. The newer ones use price taker competition or price taker model. I'll explain in a moment why perfect and why price taker. Whereas the second model here is the price searcher model that is so heavily emphasized in your book, used to be called back in the day imperfect competition or monopolistic competition. Imperfect or monopolistic competition. Okay, so let us start with the price taker model. So whenever we develop a certain model, we have to lay out in advance what are the restrictions of the model, what are the conditions that we impose on reality, what are the assumptions under which we perform our analysis. There are six or seven different characteristics of this model that we want to study. The first one is there is a large number of firms operating in any given market. So for a particular market to be described as competitive within this model, you need to have a very large number of competitors, a very large number of firms. So it wouldn't do to have 2 or 3 of them. That's suspicious. That's not good enough. Ideally, you will have an infinite number or a very large number, thousands or millions of firms competing on the market. So we know that not all real markets conform to this expectation to have a huge number of competitors, but some markets do. So, for example, stock market or some agricultural markets. Agricultural markets, by and large, correspond to the expectations of this large number of firms existing, large number of independent buyers and sellers buying and selling and producing all the time. So this is, you can call this a structural theory of competition, which means that what determines competitiveness of a given market is primarily its structure, which means the number of firms. So structural theory of competition says that there are 3 types of markets. This one which we can call perfect or perfectly competitive market with a large number of firms. Perfect, large number of firms. Then you have a market with a relatively few firms, small number of firms. This is called oligopoly. Oligopoly. It means few firms. You know, if you studied philosophy or political theory, you heard probably for the term oligarchy. You know, what is oligarchy? Oligarchy. A system in which few people control the entire government. So oligos means a few, limited number of people. So oligopoly means a system of competition in which you have just a few firms controlling the market. Classical example here would be the airline industry. So you have whatever, Airbus in Europe, Boeing in the United States, Embraer in Brazil, but I now see that Airbus wants to acquire or had already acquired Embraer. So you have just few firms controlling the entire market. So that's oligopoly, and finally monopoly. That's one firm controlling the market. So that's a structural view of competition. So you don't look at what firms do, you look at the number of firms. And you always consider that the larger number of firms serve any given market, so much the better for the competitiveness of a given market. So in a certain sense, this quite sort of corresponds to our intuitive expectations. You would usually, people in ordinary life would say, aha, there is more competition because there are more people selling in the market. Fewer number of sellers would correspond in our imagination to a less competitive conditions. Okay, so this is perfectly competitive market is the one characterized by a really, really big, huge number of firms selling in the market. The second condition here, the second description of this market would be that prices are given. So what does that mean? That means that an individual firm cannot influence the price in any shape or form. It is assumed that every single individual firm has to take a price of the product that it sells as a given piece of data, as a given parameter. The only way how a firm within this model can compete is by doing something with the quantity it produces, increasing or decreasing production. That's the only way to maximize the revenue or maximize the profit, to increase or decrease production. We will see what is the logic of this increase or decrease, when and how a firm would do so. But for now, prices are given. Every individual firm is a price taker, which means it cannot set the price of its product independently from the competition, from the market. It has to accept the market price as a given. So that's the reason why the model is called price taker. And the explanation for this is pretty simple. The individual size of a firm within this model is so small that you cannot afford to influence the market at all. They're so small. You're 1/1,000,000th of a market, so your individual size is so small. So the market is determined, the market price is determined by the acts of buying and selling of millions of people in the market, and every one individual market participant is very insignificant in size as compared to the entire market. Okay, so what are the other assumptions of the model? Perfect information. So by the way, you don't have any of this in your book. Perfect information. What the perfect information means, it means that all market participants have the information about the available trades. Buyers and sellers know about the existence of each other. It doesn't mean that everybody is perfectly rational. It means that that the market is very well informed, that people will know about the existence of buyers if they want to sell, and that the sellers will know about the existence of buyers. So that's perfect information. So I can say no information barriers. The fourth principle here is can be summed up as no barriers to entry. So what are barriers to entry? Those are barriers, those are impediments, obstacles to a new firm entering the market. So can you give me an example of a barrier to entry into a given business? Who can erect these barriers? Or what can count as a barrier to entry? Law, okay. So it could be legal barriers to entry. Can you give me some examples of legal barriers? Yeah, licensure. So I want to work as a barber, but I don't have a license. I have to pay a certain amount of money and a certification process to set up a shop. So that's a legal barrier to entry. Or, for example, you can think of taxes also as barriers to entry. So how taxes work as a barriers to entry? Because firms, already established firms with a lot of capital, can afford to pay much more taxes. People who want to start a new business, they have to accumulate much more capital in order to pay higher tax rates at the beginning. Imagine, for example, that I want to start a certain business, but there are very onerous regulations that require me to install a very expensive equipment. I can produce a good by using a simpler and cheaper equipment, but the government requires me mandate to install a very expensive equipment. This increases my costs. It increases, in a legal fashion, my costs of doing business. Barriers to entry. So legal barriers. But there are also economic barriers. Even if we assume that there is no government interference of any kind, taxes, regulations, mandates, and so on, licensure, sometimes economic costs of starting up a business could be very high. So what do you think? What is the main reason that you have just Boeing and Airbus in airline industry producing commercial aircraft? What is the main barrier to entry for new? Could we in this room just pull certain money together and then start up a commercial producer of commercial aircraft? Or why? It's extremely expensive. This upfront investment is extraordinarily high if you want to run a company like that. So even if the government doesn't intervene in any shape or form, it's hugely expensive and very unlikely that many people would have enough money to start up a business. So I have financial barriers to entry as well. So if you want to start a bakery downtown Bismarck, that may require a certain amount of money, and it imposes certain financial cost, but is far lower than starting a new commercial airline producer. So lower the economic or financial barriers to entry, more competitive the market is. So it's all the structuralist logic of competition. Everything that facilitates an increase in the number of sellers is good for competition. Anything that makes it more difficult for new sellers, new producers to enter the market is bad for competition. So that's it. So ideally, no barriers to entry, or realistically, as low barriers as possible. Lower the barriers, more competitive the market is. Fifth precondition is something called homogeneous product. That means everybody is selling the same product. no differentiation of products. What do you think? What is the justification for requiring this as a part of this model of price taker? No differentiation of products. Everybody's selling the same product. You want to study these two things. If you allow differentiation of products, you can compete in two ways. You can compete by lower or higher prices, or lower quantity produced or higher quantity produced. But if you allow people then to compete with higher quantity of product, it messes up your analysis. It complicates your analysis. So we want to simplify the model and to say, okay, let's assume we know that not everybody is going to be selling the same car with the same color or the same type of chocolate cake. But for now, we're going to assume, just in order to simplify our analysis, there is a homogeneous product. There is no differentiation. Number 6, this is funny, no advertising. There is one of the previous 5 preconditions that kind of implicitly contains this no advertising plan. Which one is it? Go ahead. Barriers. Which barriers? To entry or information barriers? Information. Why the assumption of perfect information contains implicitly the idea of no advertising? Well, everybody knows. What is the main purpose of advertising? To make your own existence as a seller known to everybody, to overcome the information barrier. If there are no information barriers, then there's no need for advertising at all. And the final condition, a very important one, is private ownership. Private ownership of the means of production. Private ownership of the means of production, which means everything that is used in the process of production. Factories, real estate, raw materials, everything but human labor. You can say that even human labor, in a certain sense, is privately owned because we own our own persons. So we are selling something that we have a private property right in. That's a concept of self-ownership. So you can say that even human labor is indirectly or implicitly privately owned. So these are the assumptions of the model. Okay. Any questions? That's one. Number 5 is homogeneous product, or no differentiation of products. Simply put, everybody's selling the exact same product. So here again, maybe the agricultural markets are closest to fulfilling this particular requirement. Everybody's selling wheat or corn. Although you know that there are different types of wheat or corn, different hybrids and so on, genetically modified, not genetically modified, this or that type of hybrid, but it's much closer to the ideal of homogeneous product than in other markets in which there's quite a bit of differentiation. Okay, anything else? Good. Now I will have to remind you of something that we've analyzed a few classes ago, that we will now need to apply today. That's what we want to do with these two models. We want to study the demand conditions that an individual firm is facing within these markets. What is the position of the demand curve for a product that an individual firm is facing? So you will remember when we did these graphs of the demand curves, some of which were vertical and some of which were more horizontal, that we said which type of the curve corresponds to a more competitive market and which one corresponds to a more monopolistic market, and why. Anyone remembers that?
Is the more horizontal one?
More horizontal is competitive or monopolistic? Yeah, more competitive. More competitive. Why? Anyone remembers the concept of elasticity of demand? So more horizontal, the demand curve. For any given change in price, the quantity demanded will change more in percentage terms. So which means that here, let's say that this is the price on the market, and this is the quantity that you charge. And your firm, you want to increase your price, let's say, by 30% here. See what happened? Your quantity dropped by 60–70%. It's almost like an economic suicide. If you're facing as an individual firm the demand curve like this, you cannot do very much in terms of increasing price. You cannot increase your revenue by charging higher prices. And that's good for consumer. And what is the main factor that contributes to the horizontality or elasticity of the demand curve? It's the existence of substitutes. If producers know that consumers have an alternative product that they can turn to if they increase the prices, they will be very reluctant to increase prices. That's why the prices of apple juice do not double routinely, because apple juice sellers know that there are orange juice and mango juice and non-alcoholic beer and many other substitutes that consumers would turn to on a dime if the price of their product increased too much. And vice versa, if the product is really scarce and that consumers really want it and do not have a good substitute, then the demand curve will be more vertical, which means that you could increase price significantly without the fear that your revenue will decline too much. That's and monopolistic firms have more vertical demand curve. Competitive firms have a more horizontal demand curve. Okay, now I'm going to draw the demand curve that this firm here in our perfectly competitive market faces. Individual firm, the market. What do you think? What would this demand curve look like? This is the demand curve, this is the equilibrium price. It's a horizontal demand curve. You cannot do anything about your price. You have to take it as a given. Now we can explain why is that the case? Why, as a single firm in a perfectly competitive market, you cannot either increase or decrease your price without losing money, without losing revenue? In the case of the upward, in the case of an increase, it's pretty simple. What's going to happen to you? There are millions of sellers who sell the exact same product at the exact same price. You increase your price, what happens to you? Consumers stop buying your product because they can find cheaper, as good an alternative at a cheaper price. You lose revenue, you're out of business. So that's simple. But what is tricky here now, you cannot cut price either. Why is that the case? You would think to yourself, okay, but at least I can cut the price, then people will be buying more from me, and the other guys will have to match my price cut. Here, it doesn't seem that they have to match. Any ideas? It's really a chance to have a really good participation rate if you can figure this one out. I mentioned it at the beginning. Go ahead.
So if you lower yours, then the price curve or the demand curve will go up momentarily make a profit possibly, but everyone else will lower theirs and it will just stay the your competition will match your price, and
Okay, they will lower their price. But that will happen no matter what. In any market conditions, you can try to do that. But the idea is here that they may not actually decide to lower prices at all. So remember, what is the individual size? What is the size of your firm as compared to the total market? It's extremely small. So imagine now yourself as a stock market buyer or seller. There are millions of people who are buying and selling. And you buy whatever, you increase your stock portfolio by buying like the stocks of a pharmaceutical company 50% or 100%. Is it going to affect the price of the stock? Not at all. If you're a one small buyer, the market doesn't care at all about your increase in purchase. So you don't affect the price if you're just one small player on the market. So the same thing happens here. One small firm reducing its price doesn't force everybody else or nobody else to decrease their prices either. Your size is so small that they can simply ignore it. And what's going to happen? You're going to have a little bit of an increase in quantity that you sell, and you lower the price, while they continue charging the same price as before. So their revenue remains the same, and your revenue gradually declines. So that's the idea. Your price cut because of your very small size doesn't affect other firms in the market because it doesn't affect the market price. So market price is determined independently. I will explain in a moment how the market price, this price here, that everybody has to take as given, is determined, but no individual firm, because of their very small size, no individual firm can influence this price. So you will be just losing money if you charge lower price and nothing else. Okay, so some concepts that we have to learn before I go back for a moment and try to explain how the market price, let's say wheat, let's say that this is a wheat market, agricultural market, how the price of wheat is determined. If producers cannot dictate the price, what dictates the price? How is it determined? But we are talking about an individual. This is the demand curve facing an individual firm. This is the price. The first category is price. Second, revenue. Remember how we defined revenue before? Price times quantity. Price times the number of units that you sell. Okay, there are three types of categories of revenue that we want to talk about. First is the total revenue. What would that be? What is the total revenue that a firm has? Let's say that the firm sells, that the price is $10 per bushel of wheat, and a firm sells, or a farmer sells 8 bushels. What is the total revenue then? $80. Which means total quantity sold times price per unit. The next category is average revenue. What is that? How would you calculate the average revenue? You're 19 years old, you're 20 years old, I'm 46 years old. What is our average age? Yes, sum all three up and divide by 3. So the average revenue is actually total revenue divided by the number of units sold. So what the average revenue per unit would be here? Total revenue 80, the number of units 8. 80 divided by 8 equals 10. So average revenue is $10. Now maybe one of the key concepts here, marginal revenue. Can you tell me what is the marginal revenue here? Another opportunity, very good participation. Great. Go back to marginal utility and think about the analogy. Go ahead, sir. How much money you make by selling one more unit. Okay, what can you tell me about the marginal revenue that this firm earns for every one unit that it sells? It sells 8 units. What is the marginal revenue for the first unit? Marginal revenue is the amount of money that you make by increasing your production by 1 unit, by adding 1 more unit to your volume of production. You start from 0, what is your revenue? 0. You produce 1 unit, what is your revenue from the first unit? 10. Okay, so this rectangle here is your marginal revenue. You go from 1 to 2, from the first to second unit, what is your marginal revenue? 10 again, and so on down the line. So marginal revenue is $10 as well. So we can say that the price in a perfectly competitive market corresponds to average revenue per unit to marginal revenue. For our purposes, marginal revenue is here the key. So remember, whenever we make economic decisions, we always base them on marginal categories, marginal utility. Whether I'm going to acquire 1 more unit of some consumer good depends on whether the sacrifices that I have to make are greater than the utility that I derive from this 1 additional unit that I want to acquire. In a certain sense, marginal costs and marginal benefits have to be in the equilibrium. If I see that, if I perceive, or if I predict, or if I expect that the benefits that I derive from 1 additional unit are greater than the cost that I have to pay, sacrifices that I have to make, I will acquire another unit. And I will keep increasing my acquisition of a certain good until I realize that if I increase it just by 1 more unit, the sacrifices that I have to make for that 1 additional unit will be greater than the benefits of that 1 additional unit. That's the moment when I stop increasing my acquisition of consumer goods. Okay, you remember that? That's marginal now. The exact same thing is here, just the function of marginal utility and marginal cost are taken over by marginal revenue and marginal cost. So you know that the marginal costs are increasing all the time. First unit costs you, the cost of the first unit is lower than the second unit, because you have to sacrifice more and more important things to acquire second, third, fourth, and fifth unit. The same thing applies here. You say that marginal cost curve. This is the marginal cost curve. That's just the easiest way of thinking about it is as about the individual firm's supply curve. It tells you at any given price how many units a firm can afford to produce. It's a marginal cost of individual firm's supply curve. It looks something like this. Don't ask me now why it goes down first and then increases. I will be able to explain you that a little bit later in the semester when we talk about the prices of production, prices of factors of production and productivity. But for now, just take it as a dogma and believe me that the marginal cost increase as you increase the level of production, and the market equilibrium of this firm will be when? Here. And the marginal costs equal marginal revenue. When this $10, when you keep increasing, the cost of first unit is $1, $2 for second unit, $3, and so on. And once you reach the level of production, the cost of which is $9.8, and you judge that if you produce the one more unit, it will cost you $11, you stop producing. So that's the equalization of marginal revenue has to equal marginal cost. That's the profit maximizing level of production of a firm. What happens if your marginal revenue is greater than your marginal cost? Can you tell me? What a firm does if its marginal revenue is higher than marginal cost? It cannot do anything about the price, you know that. It can do something with the quantity, with the volume of production. Increases. Yeah. You keep increasing your production until which point? Until the equilibrium. So, one profit maximizing strategy that a perfectly competitive firm or a price taker firm has is to increase its level of production, increase production, if its marginal revenues are greater, if its marginal revenue is greater than the marginal cost. And vice versa, if marginal revenue is smaller than marginal cost, what the firm does then. So the cost is here, the price is here. Obviously, your cost is higher than revenue. What you do? You want to? Yeah, increase or decrease? Decrease, yeah. You want to avoid losses. You don't want to be wasting resources in producing goods that you cannot sell on the market. You're going to go bankrupt if you continue selling at cost that at a price that is not sufficient to cover your costs. So then you decrease production if your marginal revenue is smaller than your marginal cost. So these two are the only two competitive mechanisms that a perfectly competitive firm or a price taker firm can do. Increase or decrease, adjust the volume of production to the market demand. Okay, any questions about this? Now, the next thing is, what determines this price here? So I'll tell you how competition works here is that something determines this price. This price changes, fluctuates up or down, and firms adjust to these fluctuations by increasing or decreasing the level of production. Imagine that you have another firm here that has a cost curve like this. What can you tell me about this firm number 2 as compared to firm number 1? Its supply curve is more moved to the right. So at the same price, this firm can produce more. So this firm is more efficient. Firm 2 is better, more efficient firm than firm 1. But there is one thing that they have in common, that they will increase or decrease their levels of production, which are different, dictated by their different levels of productivity, only depending on the changes in this equilibrium price here. Demand curve will shift down or up. So if the demand curve goes up, both of them will increase production. So this firm will move from 10 units that it sold in the equilibrium before the change in price to, let's say, 11. And the less efficient firm would move from 8 units, our firm that we studied thus far, to, let's say, 9 units. And vice versa. If the price goes down, the less efficient firm would go from 8 units to 7 units, and the bigger firm from 10 units to maybe 8.5 or 9 units. But what dictates this price here? Now pay attention to this. We have a separate market in which the prices of products are determined. And here the demand curve is your regular downward sloping curve. So this is the market demand for wheat. And this is the equilibrium price here. This is the same price here. This is the price that every individual firm has to take as given. Now, what can you tell me now? Which factors can influence the fluctuations of this price? It is determined by the supply of wheat and demand for wheat. Can you give me some examples of the factors that can influence the aggregate total demand and total supply of wheat? Let's start with the demand for wheat. What can you give me one example of change that can shift the demand curve for wheat in this direction? If the supply remains the same, then it will lead to higher price. Then the price will go up. Yeah. If price of bread increases, and why would price of bread increase? I sometimes joke that if all people in North Dakota adopt the Eastern European habits, nutritional habits, and start eating bread with everything, including potatoes, then the price of bread will increase. Everybody is Eastern European, the price of bread goes up, the price of flour goes up, the price of wheat goes up. What happens then? There are a variety of other things. The supply curve can shift. You have a better harvest. Supply curve shifts to the right, the price will go down. Or bad harvest or bad weather. The supply curve shifts to the left, the price increases. So many supply and demand factors can influence the change of the equilibrium price of wheat. But basically what determines this price is the ratio between the scarcity of wheat for consumers and scarcity of all other things for consumers. How much people prefer wheat with a given level of income that they have, vis-a-vis corn, vis-a-vis chocolate cakes, vis-a-vis cars, vis-a-vis drinks, vis-a-vis college tuition fees, and so on and so on. And now this is the mechanism. This is the market demand, or the demand curves and supply curves that exist in the total market. They determine of wheat on the market. And now the quantity demanded will have to change depending on the changes in prices. This is the purpose of firms here. Firms react to a given change in price by adjusting the quantity. So what we want from the market to do for us if the price of wheat increases. That means consumers want more wheat, more bread, whatever. We want then the firms, the productive side. This is a productive side. Productive. This is consumer side. You know that the market economy, the magic of market economy, the goal of market economy is to make these guys here serve these guys here, their preferences. How these guys here serve the preferences of consumers? Price goes up, what do they do? In order to maximize their profit, they increase production. Lo and behold, magic. They increase production, supply the market with more wheat. The price goes down, demand for wheat has gone down. What they do, in order to survive in business, they reduce production. You see, there is a harmony between producers and consumers in the market in this very, very simple, primitive model. And that was the purpose of this perfectly competitive model, actually, to demonstrate this very simple fact that if you have independently determined demand for a given good, the firms that work in accordance with these 6 or 7 principles that we laid out will be very efficient in allocating resources to produce an optimal quantity of the good in question. You don't need, the theory was developed in 1920s and 1930s. And that was not an accident that was developed then, because that was a period of very high popularity of socialist ideas of central planning. I said, you know, you need to have somebody in charge in order to determine how much wheat are we going to produce, how much steel, how much everything else. The Soviet Union was at that time very popular. Their economic system was very popular in America, among intellectuals at least. Mussolini's and Hitler's socialist planning economy was very popular. And economists said, no, you don't understand. You can allow, I'm going to develop it. The economist who developed this model is called Frank Knight. If you ever get a chance to read anything with Frank Knight, I recommend it highly. He said, you don't understand, you don't actually need a central planning body to have an efficient allocation of resources that are devoted to the satisfaction of the most pressing consumer need. And I'm going to develop you a very simple primitive model that will show you this. And this is the model. But just by adjusting the levels of production, the firms serve millions of firms. He said, I'm going to assume the most unfavorable conditions for my side, for the free market side. I'm going to assume there's an infinite number of firms, like millions of firms. And still, they're going to be efficient in achieving the goals of optimal allocation of resources, which means satisfying consumer needs, just by following their profit model. Price goes up. The only way for me to maximize my revenue, my profit, is to increase production. That's exactly what consumers need. Price goes down. The only way for me to maximize my revenue is to reduce production. That's exactly what consumers need. Okay, so now I hope that you can see the justification for engaging in this ridiculous exercise with a model that is not realistic in any shape or form. It's not a realistic description of the real world, but nevertheless serves a very important purpose to demonstrate this idea that, let's say, the invisible hand of the market works to a certain degree, at least. Okay, any questions? Okay. Now we're going to turn to the second model. And I will greatly abbreviate and simplify the discussion of this model, price searcher model, as compared to what your book does. Because this is 101 economics, and my microeconomics classes, I will cover usually this model in much greater detail. I will just give you a few basic pieces of information about this model, what is the justification for this model, and what it tells us. First, similarities and differences with the price taker model. I'll give you a list of things that these two models have in common. First, no barriers to entry. Private ownership. A large number of firms. Crossed out. It's allowed that there are just a few firms. So this is the first condition that is eliminated. Homogeneous product. Crossed out. You can differentiate products. You can compete by higher quality. Price taking. This is the key. Your price setter, which means that the firm in this price searcher model has the ability to some degree to adjust its prices, not just its quantity. Price setter or price searcher? That means that your profit strategy within this model, now you see that we are getting more realistic here, that we are allowing more and more stuff that we see in the real world to enter the model now. So this model is just a complication of the previous one. By reducing certain restrictive assumptions, we are making it more complicated, more difficult to deal with, but more realistic in exchange. So there is no perfect information as well. So you remember that in the perfectly competitive system, you will have that the price will equal marginal revenue. Price that you can charge on the market will correspond to marginal revenue. So marginal revenue is the revenue that is that you sell at which that you acquire by selling one additional unit, and it equals price and equals marginal cost in the equilibrium. Remember the model of perfect competition. Here, the price is always a little bit bigger than your marginal cost. And your marginal revenue is always a little bit bigger than your marginal cost. So why is that the case? Because you're allowed to compete by increasing quality. Now, you don't have a homogeneous product, and actually the products of higher quality will command a slightly higher price. Okay. How this works. What is the position of the demand curve that an individual firm faces in this market? The price is the basic price is determined, the equilibrium price is determined still in the same sense in which it is determined in a perfectly competitive market by the conditions of supply and demand for whatever, for cars, for. But the individual firm's demand curve is downward sloping. That means that as an individual firm, you can choose your own combination of prices and quantities that you're going to sell on the market. So you can decide to charge $8 per unit and to sell 10 units. That's your equilibrium combination. Or you can decide maybe to charge 10 units, to charge $10 and sell 6 units. So whether you are going to decide to increase your price, what will determine whether you're going to increase your price from $8 to $10? Would you increase your price from $8 to $10? If this were your demand curve and these were your expectation? What's going to be your marginal revenue, your change in your total revenue as a consequence of this decision? You don't know this, of course. This is your expectation. You don't know the exact position of the demand curve because you don't know exactly what are the preferences of consumers, but you think this is the way how it works. So what is your total revenue with the price of $8? $80. What happens if you increase price to $10? It drops back to 60. So $20 worth of. So you're probably not going to increase the price. So see, there is a trade-off here between, on the one hand, gains in total revenue on account of higher per unit price. Change in total revenue. Delta P, change in P, and change in quantity. So we know this is a normal demand, downward sloping demand curve. Whenever you increase price, the quantity goes down. Whenever you decrease price, quantity goes up. Now, which is more likely? Whether you're going to increase the price depends on the position of the degree of verticality of the demand curve, which means which one of these two will be greater, change in price or change in quantity. So here, that practically means whether this rectangle here is going to be greater than this here. They have in common these two. These two are the difference. This. Let's estimate the exact surface of these two rectangles in order to gauge whether your price increase or price decrease will make sense economically. So the price taker model allows for a couple of changes. The first change is that you can compete by increasing the quality of product. You cannot, one limitation that remains, you cannot change the product. You cannot invent something else that makes the previous product obsolete. But for example, you can paint a car in green. Remember Henry Ford's, you can buy Henry Ford's motor, you can buy our Model T in any color if that color is black, because they were painting Ford cars at the beginning of the 20th century in black. They believed that was the way what consumers want. Completely homogeneous product. And then they started changing colors. So you can redesign a product, but it still remains the same product. You can offer just a better or worse version of the same product. So that's one competitive mechanism. And the second competitive mechanism is that you have to decide, you have a certain degree of discretionary power to set your own prices. You can depart to some degree from the prices that other people charge. You don't have to charge the exact same price as everybody else in the business. But the reason for that is actually that you are selling a slightly different product. And if the demand curve is like this, then you have to risk. You have now risk. Maybe your anticipation will turn out to be correct. Maybe it will not. That your gain in revenue will be greater on account of your higher per unit price than the loss in your revenue on account of smaller number of units that you sell. So it's a trade-off. If you increase the price, you will sell more per unit. You will earn more per unit, but you will lose a certain number of units. So now what will be the relative effects of both of these factors? You cannot predict that with certainty, but you have to risk. The same applies to price cutting. Imagine that you're selling at $10, you're selling six units. And you're now thinking, what if I decreased if I offered the price discount $8? My quantity of sold units will increase, of course, but will it increase enough to make up for the loss of revenue for $2 per unit lower price? You cannot know that. So that's one headache that the price searcher firm has that the price taker firm doesn't have. You don't have to worry about your price at all. You take it for what it is, and you just adjust your production accordingly. Here you have to decide independently about the size of your production, how many units are you going to produce and try and sell, and to some degree about at which price you would try to sell. Okay, so these two are the two models of competition that are static in the sense that they take for granted the given environment within which we operate, that we are selling the same product, that we can vary them or redesign them in the version of this model a little bit, but not too much. Of course, there is another view of competition that I will tell you just very briefly something about, that is even more important. That's the dynamic view of competition. What is dynamic view of competition? That's the idea of how competition among different firms destroys the market, changes everything. One Austrian-American economist, Joseph Schumpeter, in his book written in 1940s, called this competition creative destruction. So why creative destruction? Creative, it creates something new. Somebody invented an iPhone, it created a new consumer good that can satisfy new consumer needs, or can satisfy the old consumer needs in a better way. But it destroyed something in the meantime. It destroyed the usefulness and value of other products that used to serve the same needs before in an inferior fashion. Or cars and railroads destroy the usefulness of horse and buggy, or whatever. The airplanes are in the process of creatively destroying the bus traffic of bus travel in the United States, or reducing it dramatically in significance. So that's innovations and technological change, the new products that serve the existing needs better or can satisfy some additional needs that went unsatisfied before. So that's one aspect of creative destruction. So you change, there are completely new products now. It's not just that you have a green car versus black car. Now you have a completely different product that is completely superior and can make your existing one obsolete. But also competition can change other things. This creatively destructive competition can change other things. For example, business forms of business organization. Corporation didn't exist 300 years ago. Now it exists. And corporations in America are responsible for like a 95% of value added in the economy. Most of American GDP is created by corporations, by corporate firms. Why is it the case? We'll come back to that later, but one of the reasons is that corporations have the access to people's savings through the stock market. They can raise the money, raise investment on the open market. Number two, they have limited liability. So what is limited liability? Anyone else on it? What is limited liability? Right.
It means that you can only lose so much.
Yeah, you can only lose whatever you invest in. That's great. Much more people will invest in a business venture if you can lose only whatever you invest in. If you start run your own private firm and you go into debt, you're responsible for the firm's debt with your own assets. If you cannot pay back your debts from your present income, you have to sell your car, your house, whatever. When you're a corporate investor, you buy $1 million worth of shares. The only thing that you can lose is 1 million. Much more people will then invest and buy shares in a corporation than invest the same $1 million in their business ventures, partnerships or individual proprietors. So this was an organizational innovation that made many other types of the firm less appealing. Or imagine internal organization of a business firm. One of the reasons why we have so many big firms right now. And there was one guy in the 19th century called John D. Rockefeller who discovered how this can work. John D. Rockefeller was the oil magnate in America, one of the wealthiest men of the American 19th century. What he discovered actually is that you can cut costs dramatically, the costs of business operations, by vertically integrating different business interests. What does that mean? That means that before John D. Rockefeller, oil and kerosene and gasoline were produced, that one company was drilling oil, then selling crude oil to another company that was refining oil. And then the refinery was selling refined product to distribution network, and somebody else would be selling it. And he figured that if he buys up the entire structure of production, if he unites into one single firm all three stages of production, you can economize on negotiating costs, you can increase the efficiency and the smoothness of the operation, you can then reduce the costs and the gas station for the final consumer. This was a huge innovation in the 19th century. Somebody figured this out for the first time. And it made the old business model in which there is one firm drilling oil, another firm doing this, third firm doing that, made it obsolete. In the same sense in which a personal computer made typewriter obsolete. A car and railroad made a horse and buggy obsolete. So you see, the innovations do not have always to be just a technological change. They could be revolutions in changing how the business is organized and run, how management is run. Marketing and management techniques were also created. People discover new ways to better organize production within a single firm, no matter how it is vertically integrated or not. That also makes the previous ways of doing things obsolete. So see, competition is much more than this adjusting prices and quantities within a given framework, within a given set of conditions. It is much more and more important, far more important in the long run is this function, the role of competition in discovering new and better ways to produce new things. While making in the meantime the old ways of doing things obsolete. Okay, so that's everything for today. Are there any final questions? So I will send you one PDF or Word document with everything written down that you need to remember from this lecture. You don't have to read chapter 8 of this particular lecture. Next lecture, chapter 9, you read the book for Thursday.